In September 1994, an electrical cable feeding a garnet machine at the Sattal Woolens factory sparked. Within minutes, the raw wool surrounding the machinery ignited, starting a fire that would sweep across the main factory floor. This was a substantial operation. The Chikhtiabad facility had an installed capacity of 1,050 metric tons of shoddy woolen yarn per annum, generating an annual turnover of roughly 1.2 crore rupees. The building itself was a heavy-duty Class A RCC frame construction. The next day, United India Insurance Company deployed preliminary surveyors to the site. Shortly after, Bhattacharya and Company were officially appointed as the final surveyors to formally assess the destruction. Given the scale of the operation and the visible physical damage, shattered roofing, peeled plaster, and severely heat-damaged carding machines, the initial expectation was a massive indemnification. The physical evidence of the disaster was entirely undisputed. Yet, the final insurance indemnification for the destroyed assets was exactly zero. The insurer formally repudiated the claim. Repudiation is a specific legal action where the company denies that any valid contract for liability exists for the event in question. This case demonstrates how a policyholder's failure to adhere to strict evidentiary timelines and baseline disclosure requirements hands the insurer a legal mechanism to erase their financial liability entirely. A commercial property policy is a strict contractual framework. Failing to navigate its procedural rules will void the cover long before the damage is ever quantified. On October 7, 1994, the final surveyors arrived on site. Their methodology required an immediate inspection of the damaged building, machinery, and accessories before any debris was disturbed or dismantled by the factory owners. Their preliminary report pinpointed the ignition source. Under the exact heading, Probable Cause of Loss, they concluded that a short circuit in the electric motor or power cable of the garnet machine caused nearby rags to catch fire. The blaze caused major structural damage to the AC sheet roofing, partition walls, and extensive heat damage to the carding sets and hopper sections. The insurer needed an immediate estimate to set aside capital reserves for the incoming claim. Based on visual inspection, surveyors noted liability would be approximately 75 to 80 lakhs rupees, but this came with a critical caveat. The report stated, "The insured has not submitted their estimate of loss, despite requests made within days of the fire." This distinction is legally vital. A surveyor's provisional estimate is an internal placeholder for the insurance company's balance sheet. It is not a formalized claim. To actualize the policy, the insured is required to submit a detailed, itemized proof of loss, complete with specific financial metrics, within a standard 30-day compliance window. Because Sattal Woolens maintained an absolute evidentiary void, the surveyor's initial 80 lakh assessment carried absolutely no legal weight. The insurer had a risk marker, but no actionable claim to process. Throughout 1995, the surveyors sent repeated, documented requests for loss estimates and meetings to finalize the claim amount, specifically mailing notices in March, July, and December. The policyholder responded with complete, total silence. They failed to provide a single standard document, ledger, or financial record to support their recovery. Then, in August 1996, nearly 2 full years after the factory burned down, the insured abruptly reappeared. This chart compares the initial estimates against the sudden escalation in the demanded payout. The insured's private consultant set a new estimated loss at 5.3 crore rupees, inflating the claim by over 600% without any accompanying data. The private report lacked the foundational data required for any commercial property settlement. There were no verifiable machinery quotations, no data on equipment life expectancy, and crucially, no depreciation metrics. Commercial insurance pays actual cash value, not blanket replacement costs. Without verifiable formulas calculating how much the machinery had depreciated prior to the fire, the 5.3 crore figure was actuarially unusable. Faced with an unexplained demand and a refusal to supply documentation, United India Insurance froze the processing file. They escalated the matter, appointing Om Nityanand Enterprises to audit the claim. The massive inflation of the claim, combined with deliberate withholding of verifiable data, forced the insurer to stop treating this as a routine loss. They were now actively investigating for malified intent. The investigation culminated in a formal repudiation letter drafted by United India Insurance, which deployed 2 distinct legal vectors to declare the file a no claim. The first offense rested on the exact wording of the contract, Fire Policy Condition 6, Roman numeral 2. This clause states that in no case shall the company be liable for any loss after the expiry of 12 months from the event. If the insurer disclaims liability and the insured does not act within those 12 months, the claim is legally deemed to be abandoned. The only way to keep a claim alive past this deadline is if the dispute is the subject of a pending action in a court of law or arbitration. Sattal Woolens waited nearly 2 years just to submit an unsupported estimate. The second vector of the repudiation struck at the core of insurance law, the doctrine of uberimum fide, or utmost good faith. This doctrine requires the policyholder to disclose every material fact to the insurer. A material fact is defined as any piece of information that would influence an underwriter's decision to accept the risk or set the premium. The final investigation revealed a massive omission. Sattal Woolens had suppressed the fact that their factory had been formally referred to the BIFR due to industrial sickness. Hidden insolvency changes the moral hazard and physical risk profile of an insured asset, introducing severe maintenance neglect or even the risk of intentional destruction. By actively concealing their insolvency and simultaneously blowing past the 12-month contractual abandonment window, the policyholder legally empowered the insurer to void the claim entirely. The repudiation triggered immediate financial consequences. Without the insurance indemnification to cover the destroyed assets, the company defaulted on its massive credit facilities. State Bank of India, the primary secured creditor, moved to recover over 3.3 crore rupees. They initiated aggressive recovery proceedings against the company under the Sarfacius Act to liquidate remaining assets. This flowchart maps the conflict. State Bank targeted the insurer, demanding the payout to settle the debt. But the High Court appointed an official liquidator, who argued they were the sole authority over the company's assets, intercepting the funds before reaching the bank. The Debt Recovery Tribunal initially sided with the bank. In 2001, they passed an order overriding the repudiation, directing the insurance company to pay the claim directly to the plaintiff bank. The legal friction eventually escalated to the National Consumer Disputes Redressal Commission. The commission intervened and ordered United India Insurance to make an interim deposit of 1.10 crore rupees to the state bank, pending a final resolution on who actually held the right to the funds. In commercial property insurance, the physical destruction of your assets is only the first hurdle. Securing a payout demands absolute transparency, actionable financial data, and strict procedural compliance. Fail on those fronts, and your claim will be swallowed by multi-jurisdictional warfare over the ashes.
Zuber & Company, fire forensic experts and forensic engineers. Seeking answers from ashes. Seeking answers.